Hello and welcome back to Investment Research. We are November 13th. We're trading around $29.86, down about 7% on the day. But zoom out. We're still up over 230% year to date. We hit all-time highs just yesterday at $32.73. So what's happening? Is this the top? Did we miss it? Or is this pullback actually your chance to get in? So here's what I'm covering. 5 questions that matter. Can this company actually sustain profits long term? What's the real valuation story at these levels? How do Fed decisions and interest rates impact the business model? Is this a hold forever stock or just momentum? And what are institutions doing? Are they accumulating or dumping shares? Stay with me because by the end you'll know exactly where this stands. Let's go. Alright, first question. Can they make money and keep making it? Look, here's what matters. 8 consecutive quarters of GAAP profitability. That's 2 full years of real audited profits. Not adjusted earnings, not some fantasy number where we exclude everything inconvenient. Actual profit. Last quarter, Q3 results, $139 million net income, up 129% year over year. They more than doubled their bottom line. EPS hit 11 cents, beat the street at 9 cents. Now, here's what I want you to understand about sustainability. They're adding 756,000 new members every quarter. Total base now sits at 9.4 million people, and these are active users. Product count is 13.1 million, up 36% from last year. The deposit base just crossed $25 billion. That's critical because deposits are cheap funding for loans. Revenue last quarter, $689 million, up 30%. EBITDA margin at 37%. Think about that. They're keeping 37 cents on every dollar after operating expenses. That's serious margin power. But here's why I believe it's sustainable. 10 years ago, this was a student loan refinancing play. Totally cyclical, totally rate sensitive, not diversified. Now look at the mix. Financial services segment did $273 million, up 102% year over year. Tech platform, which includes Galileo payment processing and Technisys banking infrastructure, brought in $102 million, up 14%. They're building revenue streams that don't depend on loan originations. Management just raised full year guidance. They're projecting $2.535 to $255 billion in revenue and $640 to $645 million in EBITDA. They wouldn't be raising guidance if they couldn't see it clearly. Now the risk. Recession hits, loan defaults spike, the lending business takes a major hit. But charge-off rates on personal loans are at 3.44%, totally normal range for consumer lending. They've been stress testing the portfolio and it's holding up. My take? Yes, this is sustainable. They've proven they can grow and make money at the same time. That's rare in fintech. But watch 2 things every quarter: member growth and loan quality. Those 2 metrics tell you everything. Okay, second question, valuation. Are we overpaying at these levels? Trading around $30 today after pulling back from $32.73. Yesterday market cap is sitting around $37 billion. Year to date, up 231% before today's drop. Let's talk multiples. Forward PE is roughly 47 to 50 times earnings. If you're a traditional value guy, you just tuned out. I get it. That's rich. S&P 500 trades at 20 to 22 times, so we're paying more than double the market. But context matters. You don't compare a high-growth fintech to the broad market. They're growing revenue at 30% annually. When you've got that kind of growth with expanding margins, premium multiples make sense. Price to sales is around 6 to 7 times. Traditional banks trade at 2 to 3 times, but they grow at low single digits. We're growing 10 times faster. Here's the interesting part. Analyst price targets range from $14 on the bearish end to $38 on the bullish side. Most sit in the mid-20s. The stock is already trading above most targets, which tells you Wall Street was behind the curve and is now scrambling to catch up. So here's my honest assessment. This is not undervalued. It's not cheap by any traditional metric, but the question isn't whether it's cheap, it's whether the growth justifies the price. Right now, I'd say fairly valued to slightly overvalued, but not bubble territory yet. Think about it this way. If they deliver 25 to 30% growth over the next 2 years while expanding margins, which their guidance suggests they will, then this multiple looks reasonable in hindsight. The market is betting on execution, and so far, management is delivering. The risk? Two things. First, if growth slows meaningfully, this thing compresses fast. We could see a 30 to 40% drop on a guidance miss. Second, if there's a broad market rotation out of growth, this gets hit regardless of fundamentals. That's how momentum works. My view, it's priced for continued execution. There's no margin of safety here. They need to deliver every quarter. If you're looking to enter, don't chase all-time highs. Wait for a pullback into the mid-20s. That gives you better risk reward. Today's 7% drop? That's a start, but I'd want to see low to mid-20s before getting aggressive. My third question, interest rates. Because for a lending business, Fed policy is everything. Current situation. The Fed has been cutting rates. They started in September 2024, continued through this year. We're in a lower rate environment compared to the peak, but still elevated versus the 2010s. Now, here's where most people get this wrong. They assume lower rates are bad for banks because net interest margins compress. That's partially true for traditional banks. But this company benefits from rate cuts in specific ways. First, lower rates drive loan demand. When rates drop, refinancing picks up, personal loan demand increases, people feel more comfortable borrowing. Origination volumes increase in lower rate environments. We're seeing that play out. Loan originations remain strong. Second, they have $25 billion in deposits. That's cheap funding that's less sensitive to rate changes than wholesale borrowing. While deposit costs have risen as rates went up, they're still paying less than they're charging on loans. The spread is protected. Third, lower rates improve asset quality. When borrowing costs drop, consumers have more cash flow, defaults decrease. Charge-off rates have stayed stable. If rates keep falling, that's a tailwind. Now the flip side, if rates drop too fast or too much, net interest income could take a hit. The spread between what they pay depositors and charge borrowers could compress. But management has been smart here. They've been diversifying into financial services and tech platforms that are less rate sensitive. Financial services revenue up 102% year over year. Remember that. Looking forward, the market is pricing in potential additional cuts in 2025, but there's uncertainty. If inflation stays sticky, the Fed might pause. If the economy weakens, they might cut more aggressively. Either scenario has implications. Here's what matters for this company. They're positioned reasonably well regardless of direction. If rates stay elevated, their deposit franchise gives them an advantage. If rates drop, loan demand picks up. The diversification into less rate-sensitive businesses gives them downside protection. My take? Rate risk is manageable here. It's not a reason to avoid the stock, but you need to monitor Fed decisions and their impact on net interest margins each quarter. If you see margin compression accelerating, that's a yellow flag. My fourth question, is this a buy and hold for 10 years or just a trade? Look, here's my honest view. This can be a long-term hold, but you need the stomach for volatility. Let me explain. The bull case for the long term is compelling. They're building a full-stack financial services ecosystem. Banking, lending, investing, crypto now, with the recent launch, payments infrastructure through Galileo. They're trying to be the one-stop shop for millennials and Gen Z. If they execute over the next decade, the market opportunity is massive. They've got 9.4 million members now. US population is 330 million. Addressable market in the hundreds of millions. If they can grow to 20, 30, 40 million members over the next decade, while expanding products per member, the math gets really interesting. They're averaging about 1.4 products per member now. If that goes to 3 or 4 products per member, revenue scales dramatically. The tech platform business, Galileo and Technisys, gives them infrastructure revenue that's recurring and high margin. That's the sleeper asset here. If they can grow that segment meaningfully, it changes the valuation conversation entirely. Now here's why you need the stomach for volatility. This stock has had 42 moves greater than 5% in the past year. It's up 231% year to date, but it's also dropped 10% in a single day recently. If you can't handle 20 to 30% drawdowns, this isn't for you. Also, fintech is competitive. You've got traditional banks digitizing, you've got other fintechs like Chime, you've got big tech potentially entering financial services. The competitive landscape is brutal. They need to keep innovating to stay relevant. Regulatory risk is real. They just got their bank charter, which is huge, but banking is heavily regulated. Any regulatory changes could impact the business model. Student loan dynamics, changes to lending regulations, crypto regulations with their new offering, all of that adds risk. My take? If you believe in the long-term vision and can stomach volatility, this can be a core holding, but I wouldn't make it more than 5% of your portfolio because of the risk, and you need to review it quarterly. This isn't a set it and forget it stock. You need to watch member growth, product adoption, margin trends, and competitive positioning every quarter. If you're looking to trade it, the momentum is there, but momentum cuts both ways. You can make 30% in a month or lose 20% in a week. Set stop losses if you're trading. Institutional investors, what are they doing? Fifth and final question, what are the big money players doing? Are they buying or selling? This is where it gets interesting because institutional activity tells you what the smart money thinks. Let me walk through recent moves. Mitsubishi UFJ Asset Management just increased their stake by 12.5% in Q2, now holding about 4.9 million shares. That's a meaningful position increase from a major institutional player. They're adding, not trimming. On the flip side, Grange Capital reduced their position by about 30% in Q2, cutting to around 59,000 shares. But context matters. That's a much smaller player, and position trimming after a big run is normal. Cathie Wood's ARK Invest has been active. They've been trading in and out, which is typical for ARK. They sold some shares recently, but they've also been buyers earlier in the year. ARK's style is momentum based, so they're not a great long-term signal, but they do add trading liquidity. Here's what really matters. Short interest is around 100 million shares, about 8.7% of the float as of mid-October. That's down from late September. Short interest decreasing while the stock is rallying. That's shorts capitulating, which can add fuel to the upside. Institutional ownership overall is high. Big players like Vanguard, BlackRock, State Street all have positions. That's typical for a stock this size, but it shows there's institutional support. Now here's the nuance. We're seeing increased options activity, heavy call volume recently, which suggests traders are betting on continued upside. But options can also signal short-term speculation, not long-term conviction. One more thing. The company just launched crypto trading, making them the first nationally chartered bank to offer it. That's a bold move that could attract new retail and institutional interest, or it could add regulatory risk. Institutions will be watching how that plays out. My read on institutional activity, net positive. You're seeing major players like Mitsubishi adding size. Short interest is declining. Options activity is bullish leaning, but you're also seeing some profit taking after a 230% run, which is completely normal. If institutional ownership suddenly starts dropping meaningfully, that's a red flag. But right now, the smart money seems comfortable holding and in some cases adding. That's a green light, not a stop sign. Alright, so 5 questions. Here's the bottom line. Can they sustain profitability? Yes. 8 quarters of profit, doubling year over year, diversified revenue streams. It's real. Valuation, priced for perfection, not cheap, but not bubble territory if they execute. Fair to slightly overvalued. Don't chase, wait for pullbacks. Interest rates, manageable risk. They benefit from rate cuts in some ways, hurt in others. Diversification helps. Watch net interest margins. long-term or short-term, can be a long-term hold if you can stomach volatility, but you need to review quarterly, not a set it and forget it. Institutions, net buying, major players adding, shorts covering. Smart money is comfortable here. My final take, this is a high-quality fintech with real profits, strong growth, and a compelling long-term vision. But at $30, you're paying up. If you're not in, I'd wait for a pullback to the low to mid-20s. If you're already in, hold but watch the quarterly numbers closely. This is not the time to get greedy at all-time highs. That's it for today. If you found this helpful, hit the like button, subscribe for more analysis, and drop a comment with what stock you want me to cover next. See you in the next one.